2024 was a standout year for Malaysia. Growth was solid across the board, and we expect growth to be about 5.2% in 2024 versus 4.5% in 2025. Now, growth has improved across the board in terms of household spending, investment spending, as well as exports, which have basically driven headline GDP growth this year. In terms of household spending, we've seen wages increase on both nominal and real terms, which has supported household balance sheets. In terms of investment spending, crucially for 2024, much of the increase has actually come from the private sector, which in our view underscores the improvements in public sector spending as well, which has basically motivated and supported private sector growth. On the export front, the improvements have been broad-based across the manufacturing sectors as well as some of the commodity sectors, which is surprising because at the start of the year we did expect that there would be a moderation in commodity export growth overall, given that prices were declining. But prices did stabilize through the course of 2024 and we saw overall export growth improving. The interesting thing about Malaysian exports is that they are supported by a broad base across commodities as well as across trading partners. And that essentially means that about 40% of Malaysia's exports are focused on manufacturing, particularly electronics. About 30% is on commodities, and the remainder 30% is well split between things like chemicals as well as labor-intensive sectors such as textiles. In terms of trading partners, Malaysia's top trading partner is the ASEAN region, followed very closely by China as well as the US. Interestingly, in 2024, export share to the US and to China were almost on par with each other. Now, going into 2025, there are a lot of questions around what will happen with international trade and how will Malaysia be impacted. Setting the record straight, as a small open economy, Malaysia will be impacted to some extent if there are global tariffs. And particularly if the United States decides to slap tariffs on Malaysia alone, there will be an impact to growth. As per our estimates, the impact to growth could be anywhere between 0.9 percentage points to about 1.4 percentage points, depending on the rate of tariff slap, 10 to 20%. However, if the tariff increases are limited to mainland China alone, we do actually think that the Malaysian economy will only be modestly impacted in the short term, and in the medium term continue to benefit from the supply chain diversification that we've seen since 2017. Essentially, the story of Malaysia then becomes a fairly dichotomous story in 2025 and is quite dependent on what happens in terms of the tariff story from the US. Now, setting that aside, the fundamentals of the economy, however, remain strong. At 4.5% growth in 2025, we expect that the economy is growing at potential, that private consumption will continue to improve, supported by certain measures, including a civil servant salary increase in December, a 13% increase in minimum wages, changes to the EPF account that were made in mid-2024 will continue to support disposable incomes into 2025. On the investment side, the public sector investment pipeline remains solid. The longer term projects have continued from the previous years, and these are multi-year projects, so we expect them to continue into 2025 as well. The private sector, as far as we can see, remains incentivized to continue with investment spending, and all of these will support growth. Our baseline is for export growth to reduce modestly as we go into 2025 because semiconductor growth is expected to slow. However, as we just discussed, there are many known unknowns, so we do take that with a pinch of salt. For B&M, the biggest consideration will be inflationary pressures. Now, the government has stuck to its story of fiscal consolidation. It does expect the fiscal deficit to narrow to about 3.8% of GDP in 2025. But this is contingent on subsidies and social assistance spending dropping by 14.4% next year. This drop basically means that RON 95 retail prices will have to be increased in 2025. Our read of the 2025 budget suggests that this could be a one-time increase of about 20 to 25% by about July next year, which will help the government achieve the fiscal deficit target. Now, a 20 to 25% increase in RON 95 prices also means that headline inflation will be impacted. We estimate that headline inflation will average about 2.7% in 2025 versus 1.8% in 2024. This is also taking into account changes such as the minimum wage increases and civil servant salary increases. The bottom line for Bank Negara Malaysia in 2025 is that it will remain vigilant of inflationary pressures, particularly second-round inflationary pressures that could stem from changes to fiscal policies. Our baseline remains for BNM to keep its policy rate unchanged through 2025, but we do not rule out, or rather we do see some risk of a rate hike, particularly in the latter part of next year, should inflation become more persistent. In the interim, BNM will continue to support the ringgit as we have seen in previous measures. Just recently, BNM announced further FX liberalization measures in accordance with the measures that it announced in February this year to support the currency. As such, the government is quite crucially aware of these changes and the known unknowns as we go into 2025. And it is building a certain resilience or a certain pipeline in terms of foreign direct investment inflows. The Prime Minister, Anwar Ibrahim, has traveled to numerous countries across 2024, gaining investment commitments from various trading partners. 2024, in fact, started off with a bang when the Johor-Singapore SEZ was announced. We expect to cap the year with further details on the SEZ, trying to analyze or trying to understand whether there will be a real economic impact and to what extent. As we go into 2025, it will be an exciting year for Malaysia as growth is set to diversify across the country, possibly into Johor as well as out of Selangor, and continue in places like Penang, where the electronics and electrical manufacturing sector remains solid. The story here for Malaysia will be more inflationary for 2025. We do have a lot of pipeline pressures building, and so Bank Negara Malaysia will remain more vigilant, at least in terms of second round inflationary pressures going into next year. But for a small open economy like Malaysia, as we've already mentioned, the various risks are usually on the external front. So policy stemming out of the United States will have a huge impact on this country, and that's something that we will closely watch for as we head into 2025.